Module 7.1 marks a significant change in the material that we're covering. We're moving away from valuation to static risk measures. Remember, the book has three parts. Valuation, focused primarily on what the fair value of underlying instruments ought to be. Static risk measures is focused on basically the partial derivative of various variables that influence the valuation. And the final part of the book is dynamic risk measures, where we can do Monte Carlo simulations and other methods to look at how valuations change in light of multiple changes. So static risk measures is a first step towards dynamic. It's also extremely important and valuable in appraising different risk exposures, things like stress testing. Our focus here, however, will be primarily on taking numerical derivatives or analytic derivatives. Module 7.1 just introduces a unique way to compute the static risk measure based on something known as centered differencing. In the introduction to Chapter 7, we briefly remind you of the difference between a total derivative and a partial derivative. If we have some function y, which is a function of x1 to xn, the total derivative with respect to x1 is the partial of y with respect to x1. The key with the total derivative is that if x2 is a function of x1, then the total derivative must incorporate this embedded functionality. Alternatively, the partial derivative with respect to x1 will ignore any other embedded functionality. You can think of a stock might be a function of volatility, and that volatility, a call option may be a function of the stock itself as well as a function of volatility, but volatility itself may be a function of the stock price. And so partial derivatives, we ignore that embedded functionality. So if we have some function where x2 is explicitly identified to be a function of x1, the total derivative would have to take into account the sensitivity of x2 to x1. The partial derivative would ignore it. Many finance-related functions have embedded functionality. The stock price, as I was just mentioning, may be a function of volatility. In many cases, if volatility rises, then a particular stock price will decline. Option valuation models depend on both stock prices as well as volatility. Embedded functionality is often ignored. That is, we take the partial derivative, not the total derivative. The central finance concept of this particular module is focused on centered differencing. Many quant tasks involve computing numerical derivatives, and we're going to review here how that gets done, as well as review applications of numerical derivatives in finance. But to get started, suppose we're having to work with the compound option pricing model or option valuation model that we examined previously. And so you could imagine, if you were assigned the task, how much will this compound option change if we change calendar time? That is, what is the partial derivative of the value of the compound option with respect to calendar time? Well, all the present value functions have time in it. These bivariate CDFs have time in it. The univariate CDF has time in it. The optimization function to get S star has time in it. And so that's a mess. And so oftentimes, that's a particular mess that we will compute when we get there. But it's important to know that there's a simpler way to get this derivative without actually analytically deriving it. So we estimate Greeks in option valuation very often. We need the delta, gamma, and theta to validate the PDF. The PDE if it's a reasonable solution. We could estimate the delta of that compound option and the gamma and the theta Vega, recall, is a sensitivity to changes in volatility. Rho is a sensitivity to changes in interest rates. Well, analytic or numerical, one reason to build out numerical is just to validate that your analytical answer is correct. And so another valid reason to do numerical is when you don't want to take the time and effort to actually derive the analytic solution. Derivatives show up a lot in finance, and the bond math involves duration and convexity, particularly when we're trying to do asset liability management. We can move from yield volatility to price volatility using numerical derivatives. All the option pricing models, the standard and advanced Greeks. When we get to value at risk, we'll see that we need delta and delta gamma var. Merton's model of default probabilities require a delta estimate. And there are many other numerical derivatives or many other uses of numerical derivatives in quantitative finance. In this particular method, in this particular module, we're going to go over the centered differencing method of Eberle. I ran across this many years ago and found it extremely valuable. And so Eberle noted that assuming f of x, where x is ranges is some real number and f of x is also some real number, and whatever derivatives I need of f of x exist of all orders at x sub 0, then Taylor series gives me a method to estimate the value of f of x given the derivatives at f of x 0 and how far x is from x 0. With that, Eberle had a write-up which I cite in the materials provided online. Provided the way to actually estimate the dth derivative, where all I need to be able to do is value the function at different increments related to h. And so this particular methodology and how and why it works is beyond the scope of what we're trying to do here, but it works extremely well. And so the order 1 of Eberle's method, or the numerical derivative order of accuracy 1, is what most of us have seen. The first derivative is simply plus and minus some increment h, and then we divide by 2h. That gives me an estimate of the first derivative. The second derivative is just you take the high value minus 2 times the middle value plus the low value divided by h squared. But if for whatever reason this particular estimate of the numerical derivative has too much error in it, I can go to order 2. And this method looks a little different. It requires estimating the function at 5 different locations, dividing by 12h squared. If I go to order 3, in theory, I'm getting more accurate by having more estimates and refinements. And then I could go to order 4, and you could actually continue on, but this was far enough. And so just to give you an idea, with order 4, I could compute the 8th derivative, looks something like this. Not that we would ever need it. There's some R code provided in this particular module that illustrates if I let the first derivative be 1%, and I'm trying to calculate the first derivative of the bond value with respect to a yield to maturity or modified duration. With this particular set of parameters, I have an enormous amount of error at order of accuracy 1, but by the time I go to order accuracy 4, I have a very accurate estimate. And so by moving up, the error in my estimate of the first derivative improves. But admittedly, a 1% increment is massive. So if I knock that down to 10 basis points, all of these answers are very accurate. A first order approximation is just fine. That will most likely be the case in most of your financial applications. If I move to 1 basis point, then a machine error actually starts to kick in at the fourth order of accuracy 4. And so there's a trade-off between trying to be numerically precise and also introducing machine error. If I go to way out to an extreme, what we observe is we have machine error dominates everything. And so with numerical derivatives, you have to be careful that you don't introduce so much machine error that it causes an enormous amount of trouble. There are many other Greeks. This Eberle's method can be applied to cross derivatives also, but that is beyond the scope of what we're covering here. So in summary, the numerical derivative estimation techniques are very useful in finance. We looked at a centered differencing method. Let's turn now to examine the R code. Remember, when we're examining the provided R code, it's good just to take a look at what to expect. And this particular module is very simple. We have a test program. There are some centered differencing functions. And this centered differencing set of functions actually rely on the UST functions that will be built. And so if I double click on the project file, the R code is launched. And just to work through what this actually does, again, I need to start back up here. The standard, load a few packages, the date function. If I start out with input order 1, there's some quoted price of the bond, $1 million par, yield to maturity is 2.53. That's a semi-annual pay, coupon rate's 2.25. The bond price is not given, settlement date, maturity date, and the incremental change is 100 basis points. And so what this line does is it brings in all the centered differencing functions. And if we look here, the first thing this source file does is bring in this file. And if we look at what this file contains, it contains all the valuation materials that we had before, as well as materials that we'll be looking at shortly in Module 7.2. And so, but for our purposes, we're just focused on the centered differencing, bond valuation, and yield to maturity. If we have this bond input data like we had before, we have a new variable that we're passing as the order of accuracy. And so as was previously presented, if we compute the modified duration and then or just the first derivative, the modified duration in this case is 8.71, but the first derivative is given here, and the four different numerical methods, if you looked at that, they do change, and so we can estimate the error based on the actual analytic solution. And again, we have this increasingly accurate result. If we turn to 10 basis points, as we saw before, the error rate is very, very small. And then if we go to 1 basis point, again, the error is extremely small, but then it begins to grow again due to machine error. And then if I have some gross, really small amount, the error rate actually increases. And so we need to be cautious with machine error when we're doing numerical estimations. But Eberle's method of order of accuracy is helpful in those rare cases where the centered difference method doesn't work well with order of accuracy 1.